welcome everybody. I'm so glad you guys could join us. It's pretty timely given what's going on in the market. So I'm not only your investment advisor, but now I'm the Chief Equity Strategist at Waverly. So we're getting some nice content here with these guys coming to visit us. Given the market volatility, Matt Reiner was with us the last time we did one of these, which some of you might remember. We had a lot of portfolio managers come to visit right before COVID. So the February before COVID, Matt was here talking about small cap value. So he's here talking about small cap value again, and I don't know what that means, except that he might not take any more of my phone calls. But Matt's here with Adirondack. It's a small cap value fund that he's managed for quite some time, and we've used him in the portfolios for a really long time. I have brought him here because, as usual, I look for contrarian ideas that nobody's really looking for and try and find fund managers that are off the beaten path, and that's exactly what he has done for us. And Chad is here with Driehaus. He has a really good sense of the global macro, which is really important now given the mean reversion that we're seeing in emerging markets in China. And he also started his career at the Federal Reserve, which is also a helpful skill given what's going on in the marketplace. But he is managing a small cap emerging markets fund. So the commonality between the two is that they both manage inefficient small cap assets, adding value there. Small cap in general has been out of favor for quite some time. Chad has the luxury of having the double whammy of small cap and emerging markets being out of favor, and Matt has the pleasure of having value and small cap being out of favor. So yes. It may be time that we have a mean reversion and your strategies come back in. So I'm going to let each of you just do a brief intro that'll probably be in a little bit more depth than I did. So.
Yeah, sure. Yeah, so on the mean reversion topic, so what I would say is, so what's interesting is small caps have done, on an absolute basis, they've done pretty well over the last decade, which most people care more about don't lose me money. So we've been pretty efficient at not losing money. But relative to large caps, we have woefully underperformed. Large cap stocks have been, obviously driven by the Magnificent Seven, and they've done extremely well. And it's just been hard for small caps to keep up. But so one of the things that's interesting is that if you look at over history, 2/3 of the time in any 10-year period, small cap stocks will outperform large cap. We've now gone 10 years of underperformance, 10 years straight. So it's just really long in the tooth as far as the large cap outperformance versus small cap. And there's, along with that, the valuations in small cap are at historical lows compared to their normal averages. Price to book ratios are the lowest since 2003. So there's just a lot of valuation metrics in the small cap space that's saying, this can't last forever. Eventually we have to have this kind of reversion to the mean where small cap starts to outperform, large cap starts to, maybe it doesn't underperform, but maybe it just doesn't do as well as small caps.
And before Chad speaks, I want to be real clear that both of these managers have outperformed their benchmarks. It's just that the asset class is out of style. So they're doing heroic jobs in an asset class that people just aren't allocating to. What was really interesting when we talked earlier was that Matt has been talking to people, and some people own no small cap at all in their portfolios. So not only have people migrated to the Magnificent Seven, you're seeing portfolios that are void of any diversification by asset class, which is unheard of in our industry because we talk about diversification as a means for protecting the portfolio. So you're starting to see portfolios that are absent any small cap, any value, and any emerging markets, which means if you start to see any mean reversion and assets coming back into these asset classes, they're going to get a boost just from the fact that people are woefully underweight, which I think is what you're seeing in China. Sorry, Chad, you go ahead.
No, that's a great point, Danielle. And first of all, thank you for the opportunity to be here. And thank you, everyone, for your interest this evening. And I'll just kind of build on that and sort of set the table. And I think that what Danielle said is absolutely true. And it even goes a step further in emerging markets. We see very few people with exposure to emerging markets small cap specifically. And the way I characterize this segment of the asset class is really under-owned and underinvested and under-researched, quite frankly. The core reason to be interested in this segment of emerging markets is exactly that, the inefficiency that comes about. To give you an example, we have thousands of stocks that meet our initial screens when we conduct research, but very few of those have analyst coverage. On average, there's about 3 analysts that cover a stock that fits within our investment criteria. So that really gives you the opportunity to roll up your sleeves, go out there, research these undercovered ideas. And that's, quite frankly, what gets me, excited to get out of bed every morning and go do my job is just, that sort of discovery. I think, another important characteristic of emerging markets, to be, quite simple and blunt, you invest in emerging markets because you're in search of stronger growth than what you can access in other parts of the world. And really at the core of the emerging markets small cap universe is the ability to tap into that domestic growth in those economies. So things like the expansion of the middle class, developments in infrastructure that many of these countries sorely need, as well as innovations in things like tech and healthcare. Those are representations of where we tend to find ideas within the portfolio. Another thing that I would say, and just in terms of, it's one thing to be out of favor, but I think what's probably more on your minds is what's going to cause us to come back in favor. And at Driehaus, the core tenets of our investment philosophy revolve around behavioral finance, so sort of the fusion between psychology and financial markets. And there are 2 behavioral biases that we seek to take advantage of that I think are also relevant to this conversation. First is that of anchoring. And the other bias that we take advantage of is that of overconfidence. And with anchoring, the basic idea here is the tendency to cling to the most recent information and not truly appreciate change as it occurs. This is a dynamic world. There are a lot of factors changing in real time. And oftentimes, we as human beings have a tendency to overweight the most recent information within our mental calculations. And what's the most recent information is this theme around U.S. exceptionalism. And I'm not here to tell you that that's wrong. It's been right. It's been exactly right for 15 plus years. The U.S. has grown faster incrementally than the rest of the world. The U.S. has been the home to the Magnificent Seven stocks, which have generated very strong earnings growth. But what might be changing around that? A big part of the U.S. growth has also been driven by stronger fiscal spending than what we see elsewhere in the world. The U.S. has run a budget deficit recently of 7 to 8% of its GDP, whereas in the rest of the world we're seeing things more like 3 or 4%. Well, guess what's happening incrementally? The U.S. may be pulling back some of its fiscal spending, whereas Europe is now starting to spend more. China is now starting to spend more. So that growth differential that's coming from maybe exorbitant fiscal spending is now starting to fade. And certainly the Magnificent Seven stocks have been in exceptionally strong market positions. These are leaders in their space. They've had positive earnings growth and incremental positive earnings revisions as well. So that's supported the growth that we've seen in those companies. However, we have new innovations in places like China. We have factors causing capital to now shift away from the U.S. And so, I think at the core of where we may see an opportunity is this dirty little word called diversification, which you have maybe not needed when you have 7 stocks leading the market higher. But now that things may be changing or on the cusp of a change, diversification may become much more relevant for your portfolios. And I think asset classes such as these that are out of favor could be beneficiaries of that.
And I would be remiss if I didn't ask you about current events, and I think tariffs are on everybody's mind. So when you look at your individual strategies and the companies that you're looking at, how do you see tariffs impacting them? And some of it may just be psychological because right now it's like tariff ping pong back and forth, and you really can't figure out what's going on or which industry it's going to impact in isolation. So how are you thinking about that as you construct the portfolios?
So the one advantage we have, being a small cap value fund that's domestically focused, is most small cap companies their manufacturing is in the U.S. Most of their revenues coming from the U.S. They're very U.S. centric. So, the tariff talk isn't as relevant to us from that standpoint, because they do have manufacturing here, because they do sell here, it works out, better for us. Now, some of them do. Some have some exposure, but it's very small compared to a large cap multinational company. So we feel a little bit protected from tariffs. Not to say that, what we fear more is when all these asset classes start trading in tandem, which we've seen in other disaster scenarios.
So there's a scenario where assets could migrate to smaller domestic companies because they are buffered from tariffs.
Yeah,
in a way.
Yeah, there could be an argument for that, and we'll see if it plays out. It'd be, we have seen this in small cap values. I actually saw there's actually been positive flows last year for the first time in a while, particularly for active managers. There was positive flows. So there's signs that that's starting to bubble, but this is just getting started. So we kind of have to see how it plays out.
How it unfolds.
Yeah.
And Chad, you also have the benefit of having some quite good macro experience as you look at this, which I think is essential for an emerging small cap manager, because each country's different and the macro and interest rates impact that asset class in a different way. So maybe a little bit more of a macro international approach or commentary on tariffs.
Yeah, I mean, we think about tariffs in a few different realms. Certainly those that have been kind of directly in the crosshairs that are in our investable universe, namely Mexico and China. And then some that are maybe a little bit less obvious, particularly if we were to see a regime of reciprocal tariffs. And those would include places like India and Brazil, which have heavily protected domestic industries. Starting with the former, look, it's very tough. What's the old saying? It's tough to make predictions, especially about the future. And I think a lot of the policies today do sort of fall into that bucket. But you can't just be dismissive. People say like, oh, there's so much uncertainty. Well, guess what? There's no opportunity for investment when everything is certain. The uncertainty is where you have the opportunity. And so I think with a case like Mexico, it's highly trade-centric. Trade as a percentage of its economy is on the order of 70 to 80%. And a vast majority of that trade occurs with the U.S. So it is directly linked to, this could have a very meaningful impact on the economy. That said, if there is one word that I would use to describe President Trump, transactional comes to mind. And specifically as it relates to Mexico, I think we can see a greater path toward some kind of deal, particularly around things like immigration and fentanyl. So it's in situations like that, there's going to be volatility. There's going to be sort of a one-for-one hit, particularly to the currency if tariffs are introduced. But we tend to view something like Mexico as potentially an attractive opportunity to buy into that. Now, China is also an interesting case because we've all witnessed in the last 25 or more years the dramatic rise and ascent of Chinese manufacturing. Today, trade accounts for about 37% of China's GDP, but what's counter to Mexico, China only drives about 15% of its exports to the U.S. In the past decade, China has increasingly formed relationships with the 7 billion people that reside outside of the G7 economies, and today is much more interested in finding homes for its exports in those countries as opposed to, say, the U.S. or Europe. Doesn't mean the U.S. and Europe aren't important trading partners. They absolutely are. But I think that China is diversified in a way that it has not been before and is increasingly taking advantage of these kind of trade linkages that were not as prevalent several years ago. I think in the case of India and Brazil, these are, again, cases where, we're watching. With reciprocal trade, the idea here is that tariffs will be equalized. Whatever trade, tariffs they have on U.S. goods, U.S. would turn around and put the same amount of tariff on those goods. And that could be quite impactful if we were to see some negotiations come to pass. Particularly in India, where things like market access could be a very important negotiating tool, particularly for some large companies that where the core shareholder and founder may have some increasingly close ties to the U.S. government. So those are, it's a dynamic world. Those are a few things that we're watching with respect to tariffs. I'll maybe take it down to the industry and stock level for a moment, because I think that, again, this presents some interesting opportunities. And one thing that I would highlight is this kind of notion of friendshoring. And this has been prevalent for several years and represented in our portfolio with an increasing allocation to industrial companies in Korea. And these are, the basic commonality among the three industries that we have in the portfolio, which include shipbuilding, power equipment, and defense companies, is that many of these Korean industrial companies are able to produce an increasingly high quality product at a materially lower price point, and they have spare capacity in a market that's increasingly capacity constrained on a global basis. These are all areas that have been, again, sort of fit with that niche opportunity set, the maybe under-researched, underappreciated type of opportunities that we found within the portfolio.
So I think what's interesting, you said a lot of interesting things, but I mean, 15% is what comes into the U.S. from China. So this notion that we're going to just laser focus on China as the bad guy exporting so much into the U.S., it's only 15%. I thought that was shocking. I think that people would think a lot more is coming into China, given the, really loud focus on China as kind of taking away our jobs and whatnot. It just doesn't seem true at 15%.
Yeah, and we've seen, and this has been a trend that's been in place for really the better part of the last decade. China's working age population peaked out in about 2010. And around that point, labor costs went up quite dramatically. It's far cheaper to produce something in Mexico than in China, for example. And much of that activity, particularly in lower end goods, shifted to places like Bangladesh and Vietnam. Incrementally, China is really focused on a couple of things within its manufacturing base. The first is moving up the value addition spectrum. So for industrial companies, it may be making a more sophisticated type of product or a type of product that China used to import, maybe from a place like Japan, that they're trying to produce internally for themselves. The second is really, we think a lot. It's interesting. I've gotten a lot of questions over the years about supply chains, and I know there are a lot of concern over the quality and the safety of supply chains here in the U.S. This was building even prior to COVID. It became, a huge priority during the pandemic. Well, guess what? China is equally concerned about their supply chains, particularly in the technology space. So given a lot of the trade restrictions that we've implemented around technology components and chips, China is trying to produce more locally in these very specialized areas. It's not so much about being the kind of factory to the world. It's not so much about lower end types of manufacturing, because that's increasing. It's less competitive today, given the labor and the deterioration of the demographics.
I'm going to move on to sector rotation, which the preponderance of the downward move in the market has come from this massive sector rotation out of technology. And we talked about this a lot last year, that the market cap weighted S&P 500 was really being dominated by the technology sector being north of 30% of the S&P 500, which we hadn't seen since the dot-com bubble. And that was a risk that we didn't know when, that you would see this rotation back. So what's interesting about both of these strategies is that on the small cap value side, the benchmarks are made of different sectors. So within value, the preponderance of the small cap value benchmark is financials and industrials, right?
Yeah.
So by the nature of the asset class, it's been ignored as everybody moved to technology. And within your sector, where you're overweight industrials and some of these other areas and went underweight technology last year, these strategies should also benefit somewhat from this rotation out of technology. Matt, would you start with that? And you can explain a little bit about the index. And I also think how you're underweight the financials, which is because a lot of people will also say, I don't want to own small cap value because it's just a lot of regional banks. And so he has a unique approach to that also.
Yeah. So what's interesting, as a small cap value shop, most small cap value managers or funds will have a very significant portion of small regional banks because it is the largest component of the index. It's well over 20%. we own one bank. We own one small cap bank, and it's about a 3% position. I'm not even sure if it is 3. It might be slightly under. We've just always looked at banks as very homogenous. It's kind of hard to say why one small cap bank is better than another small cap bank. We don't like some of the trends in small cap banks. You're seeing the large banks, the Bank of Americas of the world, and which they're headquartered here, right? They're all closing branches. If you talk to any of your, young people nowadays, my kids don't use banks. They don't go to banks. My daughter uses her Schwab account as her bank. That's basically it. And,
mine use their phone.
Yeah,
if you hand them money, they get scared of it. They don't even know what it is.
Yes, it's got to be Venmo or
That's
something.
exactly right.
So it's and what we're seeing is that, like in Albany where we are, a large bank Bank of America will close 3 branches, and then some little regional bank will take over the branch and open up another whatever small regional brand. And I'm like, I don't know who they're catering to, because the market for the people that are using these small regional banks just keeps declining. Mm-hmm. And yet they're still spending money on buying branches and bricks and mortar. It just doesn't make sense to us.
So your underweight is almost a secular theme, which is we're overbanked.
We're
and
overbanked.
The consumer's going down, and it's just never going to come back. It's not a cyclical one.
Yes, that's how we feel.
Okay.
It's and if financials, if there is a rotation of financials, we'll get hurt a little bit, mm-hmm. because all those banks will start to go up just because the passive indexes will buy all of them, and it'll make them go up. And we're willing to live with that. What we'll do in financials, so we'll buy insurance companies, we'll buy payment processors. So we try to get around the exposure of not having any banks by adding to industries that we find more attractive than a small bank with better barriers to entry, so to speak.
And how much technology exposure do you have in the fund?
So technology. This is the other unique thing for us for a value fund is most value funds have very, very little technology. We've been overweight technology since day one by a pretty wide percentage. Like we're double digits in technologies, and it's the index is I want to say under 5. The difference is the kind of technology stocks we buy are basically manufacturers. They happen to manufacture technology products, so they get put in the technology, industry or sector. We're really evaluating on are they good operators? Can they generate cash flow? Are they good at building these widgets, which happen to be technology products? And that's what we like about them. We feel like we don't really have that much technology exposure. We actually have manufacturing exposure that's being called technology.
Well, and I suspect the concentration in large cap technology has a big valuation differential in the technology companies that you're looking at versus the Mag 7 or some of these that were overvalued, where the rotation's happening.
Yeah, that's absolutely. The Mag 7 has just been unbelievable to watch. And that was, going back to reversion mean we were talking about earlier, there's been a lot of studies that people tend to think that growth is going to be persistent. So whether it's a large cap Mag 7 stock, people they put that growth in and it's going to go forever. And then a smaller technology value stock that has low growth, they're going to calculate that to be low growth forever. But the reversion to the mean in those two scenarios it's roughly like 40% a year of those type of situations revert. And it's more likely that the small cap value name will revert higher, then the large growth name will revert lower. For our particular industry, like it's been 10 years of underperformance.
You've talked a lot about mean reversion,
yeah.
But when's it going to happen? We've had 10 years of underperformance.
Yeah.
When is it going to happen?
Yeah. There's a couple things that we think may drive it. So one is we're starting to see, unfortunately the whole market's, a little shaky right now, but we're starting to see those Mag 7s starting to crack a bit. And as they crack, we're also seeing more breadth in the market. So breadth is really good for reversion to the mean. Because everyone's not concentrated in those, the top stocks that are driving the market. They're starting to move around. And if you look at all the bubbles that ever burst, the tech bubble, and that's what always happens. Everyone gets caught up in whatever's the hot stock at that point in time, and they think it's going to go on forever, and eventually it's going to break. It's not going to go on. we're starting to see signs of that. You're seeing more market cap breadth. The valuations are so low that eventually people, you're going to see professional investors start saying, we can't ignore this anymore. We've got to start reallocating. The small cap right now, the Russell 2000 is less than 5% of the Russell 3000 right now. So 3,000 includes the 1,000 largest stocks and the 2,000 smallest stocks. It's less than 5%. Historically, it's 8%. You just need a little shift to get that even close to historical norms will drive the performance and the reversion when that happens.
So it's an interesting time because I think what we're saying is you have all the ingredients, and we've had all the ingredients for a while, but now you're starting to see this subtle shift that could indicate a change there. So another thing I think maybe would be helpful to talk about is the dollar. I think people spend a lot of time doing a lot of fundamental research, and so much is driven by how the dollar moves. There's a really strong inverse relationship between emerging markets and the U.S. dollar, and you're starting to see the U.S. dollar weaken. And in those periods where you have an extended time where the U.S. dollar is weakening, emerging markets have done historically well. Again, it's been a long time since that happened, but I think that conversation might be one worth having too.
Absolutely. And this sort of falls into the realm of the topic we just discussed. The U.S. dollar, by kind of conventional valuation metrics, has been quite a bit overvalued for some period of time. Valuation can be an interesting starting point, but valuation alone doesn't tell you much. You need sort of a fundamental trigger or catalyst for that change, for that valuation mismatch to then unfold. And the way we view the dollar is a couple of ways. Fundamentally, we look at what we just call growth differentials. Again, it kind of harkens back to the first point that I made this evening, which is the growth in the U.S. has, if anything, surprised to the upside for many years, and the growth in the rest of the world has been subpar and a bit disappointing. And what that has done is it's fueled a large amount of capital flows into the U.S. And at the same time, those capital flows have contributed to the strength of the dollar, and then ultimately has led to our trade balances continuing to deteriorate. We have potentially some factors that are changing on multiple fronts. Again, capital is starting to flow to some other destinations in the world. We're seeing capital flowing into Europe. We're seeing capital flowing into India. We're seeing capital for the first time in a while flowing into China. Second, I think as it relates to the attempts to bring a resurgence of manufacturing back into the U.S., there are a few ingredients that need to happen. Certainly, we need investment here in certain areas. We need training and the human capital and human resources. But I think all of that being said, we need probably a weaker dollar for the U.S. manufacturing to be competitive on the global stage. And this is something that J.D. Vance in particular has talked about several times. And the dollar can weaken through these flows of capital. But I think again with some of these things that we've seen thrown out by the new administration, it's sort of emblematic that you have to sort of have an aura of creativity when it relates to this. For example, could we buy foreign exchange reserves in an effort to weaken the dollar? Could we come to some sort of multilateral agreement as we've seen in the past at things such as the Plaza Accord? These are, again, things that fall into the realm of difficult to predict exactly when and how they will happen. But I think the underlying notion is for all of this to work, for the trade imbalances to be resolved, a weaker dollar does seem to be part of the equation on the longer term. And that would be potentially a very positive driver of returns in international markets.
Well, what's interesting is I think the one thing that doesn't really weaken the dollar is if we drop interest rates.
Right.
And I think our market's been fueled by dropping interest rates when there's any sign of volatility. So and again, I know you don't know the answer to this, but those two things seem to be in contradiction, which was what I was having some difficulty with at the beginning of the year, which is, okay, we're going to drop rates if anything gets bad and things are going to be fine, but we also want to have a weaker dollar. Can those two things coexist?
Yeah, it's tough to say. I do think it depends on just the broader trajectory of inflation. And I think the tough thing to campaign on if you're running in a presidential campaign is I'm going to bring down inflation by bringing down asset prices. And I think the persistence of very strong asset prices here in the U.S. has been a big contributing factor to the persistence of inflation and the persistence of the strong dollar and relatively high interest rates. So we've seen a downshift in growth expectations, which has led to longer-term interest rates starting to come down in tandem. Should we see a more pronounced negative impact on growth expectations, that could certainly lead to a precursor to lower interest rates. And if those changes in the growth outlook cause investors to reevaluate their allocations between U.S. assets and assets in the rest of the world, that could kind of work in tandem with lower rates and a weaker dollar.
Okay. That's interesting. One other thing I wanted you to highlight was we talked about the dollar, but the last time emerging markets ran and the dollar was weak. Can you talk about that time period? Because it has been a long time ago, but if you remember where you were at that time, you do remember how strongly the emerging markets outperformed. And we talked a little bit earlier about the order of magnitude of that outperformance in that environment.
Yes.
So if we saw the environment again, we should probably expect the same kind of outperformance.
Yeah, no, history it doesn't repeat, but it does rhyme. And I think again the dollar is really central to the case for wanting to invest in international markets and emerging markets. The case in the context behind the very strong rally that we saw through 2003 through 2010 in emerging markets did coincide with a weak dollar period. However, the central drivers of that outperformance were linked to things like the dramatic urbanization in China, the commodities supercycle, the growth of export-oriented businesses that were really tied to global growth trends. I think today, and our expectation moving forward, if we were to see this trend unfold again, is there may be a set of different drivers this time around. One economy that we're quite positive on longer term is India. We see a really nice alignment of a few factors. The first being very favorable demographic trends, particularly relative to other large economies such as China. We see an impetus on bringing manufacturing into the economy, which is a very low percentage of the economy today. Still around 50% of India's economy is tied to the agriculture sector. And as individuals move from agriculture to areas like manufacturing or construction, we can see a tremendous pickup in wages and productivity that should be supportive of longer-term growth trends. Three, I think we continue to see a very strong backdrop for investment in certain areas in India. One that I would point out is the power sector. And one of my favorite statistics, this is just staggering, is according to the IEA, the International Energy Agency, India's growth simply from residential air conditioning over the next 25 years is going to contribute to a 9x increase in power consumption just from that vertical. So when you start to also factor in manufacturing, more focus on construction and industry, the power demand is huge. And just that delta, that 9x increase from one segment, residential air conditioning, is equivalent to the entire consumption of Africa today of power. So we see this is not just a 1, 2, or 3 year phenomenon. We see a multi-year investment cycle specifically within the power sector in India.
And I try to be consistent within the portfolio construction. And the way we've looked at it is, AI is big, the internet was big, technology is big, but this power need and demand is going to be secular for a very, very long time. So within the portfolios, we've tended to be, as of last year, underweight technology and overweight exposure to this power consumption theme. And so when I'm talking to different managers, the like-mindedness of where they're investing is also really, it's helpful and it's cohesive in the construction process. And, I think it's really interesting also is that as we see this sector rotation, some of these ideas in power consumption and industrials, as really coming back could be powerful on their own just by the fact that the sectors are also underowned. Do you see that happening, Matt?
Yeah, we still I mean, as you said, the power consumption with AI in particular and these these data server farms is just massive, and we don't have the grid to keep up with it. Not to mention all the electric vehicles that are out there now. We don't have the grid to keep up with that. So we do think there's a pretty long runway for certain power producers, independent power producers, and utilities to actually do really well in this environment. Even natural gas producers, because it's not all going to come from green energy. There's just not enough of it. So there's going to be investments, and at least domestically, we could see both those industries benefiting. Whether it's in industrials that are supplying the pieces and the turbines and the components that are going into making these power plants or expanding them, that's an opportunity. So.
Well, and I think you have to work a little harder, right? Because it's not just in one sector or 7 stocks. It's through industrials, it's through utilities, it's through the energy sector. So you have to go across sectors and look for companies that aren't just all concentrated in one area. And I don't think people have been doing that. So I think it is a unique opportunity, and that's one we've been trying to take advantage of also. The takeaway from this is that the market's been concerning, but most of it has been this rotation out of technology, and diversification pays off. And the way we have invested the portfolios is to keep them diverse at all times and try to kind of lean into over and underweights. And these are the areas that we're starting to look at. And you can see that you have 2 managers that have a lot of positive ideas right now. And what I think might be helpful and people might be interested is your top stock ideas right now.
We own an IT services company in Vietnam. This has been our top weighting for several years. And the Vietnamese market is interesting for several reasons. I think, it fits with that very first thing I said, underowned, underrepresented, under-researched. We got to know this company. We're very impressed with what we saw. They are a early mover in digital transformations. They're providing a really niche and kind of unique type of IT services to their underlying clients. And specifically, they tap in directly to very attractive demographics in the country. There are about 100 million people in Vietnam. It's very young population, very highly educated. And one of the interesting characteristics of this company's business is they also operate an education segment. So they have sort of a captive base of employees that really helps them manage attrition, which is a key risk within that industry. So this is a company, and I think the most recent incremental development to the story, which we also find very very powerful, is they have formed a partnership with NVIDIA to set up what they call an AI factory within Vietnam. So we're certainly, as we look at the technology space, we've been very excited in the past few years for playing the so-called kind of picks and shovels of the AI trend. But this is also a company that we believe can really benefit from monetizing the benefits of AI within its already very strong business model.
We call that the second derivative of
There we
AI.
go. Yeah.
Yeah, and so I would say, so one company, it's been in our top 10 for quite a while. These are always like the best kind of stocks to own, is that we've probably sold it 4 or 5 times in the past few years just because it keeps growing and it becomes too big a percentage of the portfolio, so we trim it back, and then it grows again, and then we trim it back. And but anyway, the company is called LSI Industries, and has anyone ever been to a Buc-ee's around here? You ever hear of Buc-ee's? So they do all the LED lighting in Buc-ee's, and you know how bright it is when you go to a Buc-ee's. That's one of the largest customers, but they do it for a lot of different convenience stores and gas stations throughout the country. They do it for parking garages, car dealerships, you name it. So it was an interesting company because it was a family-owned company for years and was kind of sleepy. We got involved with it when it was a family-owned company at least 10 years ago. And it kind of just went sideways for us for a few years. And then they brought in a new management team, and the first guy was a GE Six Sigma guy, and he started, divesting plants and consolidating manufacturing. and did a really great job of like cleaning up the balance sheet, generating more cash flow, and got the company where it was a nice little, niche company that, was just executing well on what they had. And then then kind of out of the blue, which made us nervous at first, but they let him go and they brought in a new manager to grow the company. And the new manager has just been unbelievable at growing the company. He just keeps making little small bolt-on acquisitions. He buys it. So if you go to, any grocery store nowadays, it doesn't matter which chain, but, everyone wants the fruits and vegetables to look like a farmer's market. They have all those nice little wooden, things with the blueberries and oranges and everything in it. They make all that stuff. They supply all the grocery store chains. They're probably they're like the largest manufacturer of it. And that was a company called JSI. They acquired them a few years ago, and it's just been a home run, that acquisition. And that's a lot of that has LED lighting in it and stuff. So that was the commonality between what they do and what JSI did. It opened a new vertical. They had never done business with the grocery store channels before that. So now they're cross-selling their other lighting solutions to the grocery store market. So it's just one of those names that they've yet to make a mistake, and hopefully I won't regret saying that, but every acquisition they make just seems to be a home run. They pay down their debt extremely fast because they'll lever up a little bit when they make an acquisition, and then they just focus on paying it all off. And then once they get it down to a certain level, then they'll make another small acquisition. And we've always found companies that make small bolt-on acquisitions that are somehow strategic, that's the formula for success. It's the large acquisitions that cause problems. And so anyway, that's a company that we still really like. So it's interesting. One more point to that story was the Albertson-Kroger merger, if anyone saw that in the news, and that really caused a hiccup for them because the entire grocery store chain stopped spending when that merger was pending, because all the competitors were saying, let's see what's going to happen. Albertson and Kroger's, which were both big customers, stopped making changes. So there was just kind of a freeze, which caused the stock to, kind of pull back. And we actually added to it for the first time in years, because normally we kept selling it because it kept getting too big. And this time we had an opportunity to add to it because it had a little hiccup with that merger. And then, they were at the, they've said it openly, like, we don't care what happens. We just want it to be over. Either allow it or don't allow it, just so everyone starts spending again, and that's finally happened. The deal was canceled, and boom, now the only piece of their business that was, not doing as well as all the other ones for a temporary period is now back. So, we're pretty happy with that name.
It's nice to know your company so well that you can buy on a pullback.
Yes.
And I think that's the point of doing fundamental research on individual stocks and why we include them in the portfolio. And we always try to find managers that do things the same way we do. And it's really nice to have you guys here. Does anybody have any questions?
I would generally agree with that. I think the direction of travel over the past 8 to 9 years has been toward deglobalization, toward kind of a multipolar type of world, possibly instead of, just a kind of a unipolar world as we've seen in the past. I would not put India in the place in the camp of countries that we're stepping back from. I think India remains very strategic, not just for its market and the potential market access there, but really, in some ways, as a counterbalancing force to China from a geopolitical perspective. And India has been very adept at also playing off multiple relationships. You'll never find anyone in high ranks in India that will say bad words about Russia, for example. But at the same time, they want to maintain a very good relationship with us in the U.S. And Prime Minister Modi in India does seem to have a good relationship with Trump, and but also kind of understands the geopolitical importance. So I think. But aside from India, I do agree with your assessment.
So they're like the emerging market Switzerland. Yeah.
That's a good way to put it.
Will the dollar have it pick up in M&A? And M&A in small cap is normally a good thing.
Yes. So and the part on the dollar will be more akin to what Chad's doing, but generally, even in our small cap space, which is more domestic or almost entirely domestic, we're starting to see M&A activity. So last year we had 4 companies acquired in our portfolio in 2024. Our first, I think it was 12 years of our fund, we averaged 4.5 companies being taken out a year. And that's in a 50 to 60 stock portfolio. So it's a pretty good percentage. Then we went like 5 years with none, like literally none. Then it started picking up like one or two. And then last year was the 4. That was the first time we had that many in probably 10 years. So it feels like that situation is happening. It's making it. And the one thing with this new administration, you might see more of it because of the deregulation, and they're less opposed to those mergers and transactions. And it usually benefits small caps, and I'm sure globally as well as domestically, because they're smaller companies, and the whole bolt-on acquisition thing, sometimes they might have a piece of technology or manufacturing or customer or vertical that a larger company doesn't have but may want to get into. So it makes them more attractive.
No, absolutely. It's a great point. And we've seen quite a bit of private equity activity in some of the markets. And as you can imagine, it's ebbed and flowed from a cyclical basis. I actually think that's one of the contributing factors to why things are getting incrementally better in China right now is, if you flash back to, say, 2016, 2017, there was a lot of private equity money and venture money really chasing kind of companies that could maybe have an opportunity to compete with some of the large platform businesses that were really scaling up at that point in time. And since we've seen a very uncertain regulatory environment, certainly a downshift in growth, China did not deal with the pandemic well, and a lot of factors really depressing confidence. We've seen a lot of that capital kind of step away, and it's resulted in a more rational playing field and better bargaining power on the part of the remaining incumbents. But in other places like India and Vietnam, we continue to see booming private capital activity as you would expect, given the growth rates in those economies.
And to piggyback on that, I think it might be a good transition to what has happened to the number of U.S. stocks, especially in the small cap area, and the order of magnitude of how much that has decreased.
Yeah, it has shrunk quite a bit, and private equity has been a big reason for it. A lot more. It used to be the old, small companies that got to a certain size, they'd IPO, and that was the, kind of the end game. Now, a lot more private equity firms they're catching them before they go public, and then they're incubating them a little bit longer, so they're coming out bigger. Some of them are still small caps, but they're bigger small caps. They're more well-established. They're more profitable. So they're, and that's the other part of the market. We're seeing increased IPO activity. We'll see if it plays out, but the calendar looks good for IPO activity, and it's more mature companies. So we're kind of excited because the index went over a change over the last decade where, because of those companies being taken private, there's a lot more money-losing companies in the Russell than there used to be. It's like over 40% of the companies in the Russell lose money. So, and that's being an active manager. We run a 50 to 60 stock portfolio. We try to avoid the ones that are losing money. But the index buys everything. So, those money losing companies can do well if the passives are getting flows.
Are a lot of those money losing companies biotechs, or are they?
There are a lot of them are biotechs. Okay. That's one of the biggest areas of the money losing companies.
I feel like you've just got these lingering small biotechs getting smaller until they drain all their balance sheets, right? Yeah.
Pretty much.
Okay, well, thank you so much for being here. This has been great. Yeah. Really helpful.
Thank you.